Welcome to the Remarkable Retail Podcast, Season 10, Episode 3. I'm Michael LeBlanc.
And I'm Steve Dennis.
On this episode, Part 2 of your 2025 Provocative Predictions for Retail's Future. Listeners to Part 1, and there were plenty of them, thank you, a very popular episode, would know you've already nailed one of them right out of the gate. We'll talk about that a little
maybe
later.
partially nailed, but anyway, we can get to that.
Pretty nailed. I don't know. Anyway, we'll talk about that a bit later. Listen, quick mention, speaking of great new content, be sure and check out our newly refreshed YouTube page because we're uploading some great videos and all kinds of good stuff to come, and we'll be growing that in addition, of course, to the audio format. Now, let's get right into the news of the week. Week one, and the Ukraine war is not over, and the bunch of other stuff is happening. Boy, the Trump era has truly begun. We're not a political podcast, but there are some things that are relevant to retail that we did want to get into, and I'm sure there'll be more coming. But there's no question that it is a new day in America.
We won't get into the political commentary, or I won't get into it too much, but just a few things from a retail perspective. You mentioned TikTok, the ban getting kicked down the road a bit. So we will see as I predicted. Well, I'm happy to spike the football on this one, though. My intention is it's going to last more than 75 days, and that remains to be seen. There's still a lot to come. And it does seem, well, on the one hand, as I've been trying to understand this, it doesn't appear that Trump has a lot of options to extend the ban beyond the 75 days. But since the Supreme Court ruled that he's not liable for any crimes while he's in office, I don't know. But anyway,
I don't know. What do you think the extra? I mean, it's been up for sale for close to a year. Is it just one of those things that a motivating deadline will bring this to a conclusion? Like, what would change to make it? Is it an attitude from the Chinese government? Like, again, not to be political, but really, TikTok's pretty important. I
don't know. I'd actually recommend, and maybe we'll put a link in the show notes, but last week's episode of Pivot, Scott Galloway and Kara Swisher go into a lot of detail about some of the implications, various implications, not specific to TikTok, but they get into this in a fair amount of detail. And one of the things that Scott says is, well, we're not a serious country anymore because we put these deadlines out there, and then it's like, we're only kidding. So if it hasn't happened by now, and people might recall that the Congress approved this ban overwhelmingly in bipartisan support,
not an easy thing to accomplish. Not an easy thing at all. Now, a lot of these folks are taking a knee to Trump. Now he's back in office, but so I don't know. It is funny. And I'll give credit to Scott for saying this, is Trump proposed this. Maybe the government should own 50% of TikTok, which is, socialism, basically owning the means of production. So it's very ironic that if all the complaints about the socialist Democrats, that one of the first things hot out of the gate is owning is the government-owned social media. A company. But anyway, but yeah, we'll see. But one of the things, so the future is very uncertain. We're seeing a lot of creators, influencers, et cetera, as well as just regular people moving to some alternatives like Red Note and Lemonade, all Chinese, by the way. So the two other things, just real quickly, because I'd rather spend less time talking about the new Trump administration if we possibly can. But I think obviously we got the whole tariff scenario now. Depending upon when people are listening to this, Trump gave a February 1st deadline. So that's just this next week in terms of when this episode's coming out. And he said that there will be a 10% tariff on China on that date. Now, that's down from the 60% he talked about during the campaign. So that's a pretty significant difference. I don't know if this is just a kind of curry favor or a negotiating tactic or whatever. Obviously, we've got the Canada and Mexico tariffs. Current thinking is 25%. But, how much of this is negotiating versus something more substantial? And again, here's another case where these were things that were going to happen day one. And, maybe not day one, maybe day 10, maybe day 50, maybe never, right? So we'll have to see. And then the other issue really gets to labor and inflation, which is we have seen deportation actions of undocumented workers really pick up. How significant that will be, what's the impact on a labor shortage that might drive inflation up, but also shortages of food, which will have all sorts of
implications potentially. But, the numbers would have to get pretty significant, I think, before this would be a big issue. So I don't think this is like a next week issue because just the sheer logistics of deporting more than the 250,000 or so folks that were deported last year under Biden is, so, there is a level that has been absorbed.
It's interesting you mentioned the timing because, and I've been doing some research on this for one of my other podcasts, The Food Professor, 42%, and this is government figures, Department of Agriculture, U.S. figures, 42% of agricultural workers are undocumented. What a shocking number, right? Like 42%, 50% in the, just if you look at the meat processing area. And that's probably even underestimated based on third-party contractors.
Sure.
So what we talked about, and we continue to talk about, of course, Canada sources a lot of their fruits and vegetables, is what does food security look like? And they don't have to even be deported. They can just be, if what's the department that could show up? ICE, is it?
ICE, yeah. Mm-hmm.
If ICE is even threatening that they're in the neighborhood, these folks aren't going to go into the fields.
Right. No, I think that's actually a bigger issue in the near term than the sheer number of people that might actually get deported, because it's not hard to figure out whether we're talking about this off mic, but we know, and I don't know what the real numbers are, and I don't know if the U.S. has even got an estimate, but we know in construction, lawn care, food service, as well as working in the crops and processing plants, there's just a huge number. And so, if suddenly 5, 10, 15, 20% of your workers are out, it just limits the capacity. So either you've got to scramble to find other people that presumably are going to work at much higher wages, or probably some combination of if you can, shortages. So yes, I think this is potentially a really big issue. And it's happening to a degree. I think it's just a question of how significantly and how fast.
And it's not new that this has been happening, particularly violent people deported outside of the country. But anyway, it's very relevant to retail because, some folks in California, North Carolina are going to need a lot of houses built. So
absolutely.
Anyway, all right, well, let's move on. Store closings to spike this year. What are you hearing?
Well, our friends at CoreSight, who are one of the research firms, I guess you'd say, that tracks this sort of stuff, they are predicting that store closings in the U.S. will actually more than double over last year, which was actually a year that also increased. And so they're predicting about 15,000 store closings compared to about 5,800 openings.
It's a big
now, this is, I think we touched on this a little bit last week about, this idea is this a new retail apocalypse or whatever? And those numbers do sound pretty apocalyptic. What I think is going on here, I think there's several factors that are driving this. One is, and I recently saw some research on the mix of quality of retail locations, and the growth of kind of mediocre locations has been pretty, or the percent to total has been pretty significant. So we've had a couple of years, really 21 and 22, which were really strong retail years, largely owing to people having more discretionary income and stimulus. And I think, as we've talked about a couple of times, that's kind of hidden some of the frailties of some of these retailers. The last couple of years, though, as we've also touched on, most of the growth is concentrated in relatively few retailers. So there's a lot of retailers that have flat or declining sales. With inflation, margins have been squeezed, and just the ongoing kind of collapse of the middle that I talk a lot about. So I think some of these pressures of supply and demand, this imbalance, have been building, and interest rates haven't come down. And just the passage of time, people's leases come up, and if they look at business not being that good, this is the time to really get aggressive about it. So I think that's the driver. I would be surprised, frankly, that the number ends up being quite that high. My guess is it'll be closer to 10,000 if I had to guess, but still, it's a pretty significant uptake under any scenario. But I don't think that this is fundamentally the death of physical retail, because we're still going to see physical retail sales be up. It's really kind of the culling of the weak herd of stores and retailers.
It feels like that to get to a number that big, somebody pretty big is going to go out of business, like a Party City again in 20.
Yeah, well, some of this I assume I don't have the background on how they calculated these numbers, but Walgreens, for example, has already announced plans to close quite a few stores. So some of this, there's several thousand, I think, which are several retailers that have announced plans to close stores. But then, yes, there would have to be a pretty significant number of pretty major closings. And it's a little hard to work out, unless JCPenney shuts down or something like that, where you get hundreds and hundreds of stores. So we'll see. That's a little bit why I'm skeptical that it will be quite that big.
Let's talk about private label in the U.S. We've seen some big numbers coming out of 2024. My question to you is, are retailers getting significantly better at private label and therefore consumers, discerning tremendous value, or are consumers just really value seeking and will turn naturally or are turning naturally to private label? What do you think's going on?
I think it's a little bit of both. So the specific story was that private label sales grew 4%, which is not a heck of a lot higher than the total growth in retail. But and I believe the couple years before that number was more like 5 or 6%. So this has been a longer term trend. I think a lot of this owes to the flight to value pressures that people looking to stretch their dollars. The typical private label value equation is more or less the quality of a national brand at a lower price. Also done right, which isn't always so easy. You can make more money as a retailer with your private brand. So I think there's a lot of dynamics that have caused this growth. And it's not like this is a totally new thing. Lots of retailers have been emphasizing private brands, both on the grocery side as well as in apparel and other places for a long time. But I think it's more the macroeconomic factors and retailers realizing that if we lean into the consumer trend, we also can help ourselves out with profitability and not be at the mercy of CPG companies, basically.
Right. Now let's talk about a couple of spot announcements, not in as much as themselves huge numbers, but we are seeing some clipping of people from different brands and different retailers. Talk about what you're seeing, and is this AI just people finding efficiencies, or is there something else going on, do you think?
I'm sure AI is a bit of a driver. My overall guess is that it has to do with just worries about the ability to drive the top line and looking to take some costs out. So just a few announcements last week, and as you say, some of these numbers are not, they're difficult, obviously, for the people involved, but not huge in the scheme of things. But Amazon reduced a couple hundred folks in their retail operations, which is really pretty interesting, too. We had the whole discussion, which I guess we'll get to in the predictions about Amazon's grocery dreams. But, to the extent you think their physical retail might grow, interesting that they're pulling back on some numbers there. Bigger numbers at Adidas. They're cutting about 500 jobs in their German headquarters. Chanel, about 70 folks, and Chanel's not got a huge headquarters operation. But again, I think that is anticipating that luxury is not going to be booming this next couple years. Starbucks has been announcing under the new CEO a number of changes in the executive ranks, but also indicated that they're going to be cutting some jobs. I don't believe they've announced the number quite yet. So, whether this is just somewhat random or going into the new year trying to get their cost structure a little bit different, kind of result of a budgetary exercise, or whether this is really more looming signs that folks are getting worried about what the year looks like. A little hard to tell, but it's not, I think last week we talked about some of the tech headcount reductions as well. So maybe the sign of a bigger trend specific to retail.
Let me throw a bigger number at you. Here in Canada, Amazon shut down their entire Quebec operations, 1,700 stretching to 2,200 people, closing their warehouses. They say it's, as you would say, it's a way to deliver more value to the people there. When Amazon first came to Canada, by the way, they outsourced their warehouse operations. They didn't first build warehouses. Now, the government and the media is saying it's an obvious strategy to avoid unionization in a province that has a lot of unionization.
Right.
And the federal government's not taking it lightly. The industry minister wrote them a harshly worded letter because, listen, Amazon does actually a lot of business with the Canadian government with their AWS and other services. So, interesting, but it's a big number, couple thousand people, and it's an entire province. So something we should probably keep our eye on about what they're going to do next in there.
Yeah, Amazon's been, well, first of all, it wouldn't surprise me at all that that's union related. We've certainly seen that from plenty of other companies in terms of store closings, facility closings, et cetera. Amazon's definitely been on a push to rework their fulfillment network. They kind of went crazy a few years ago. I think we talked about it in the first or second season about how much investment they were putting in new fulfillment centers. And some of that made a ton of sense just in terms of being able to do same day, next day delivery.
Yep.
But Andy Jassy has been doing a number of things to try to improve their efficiency. So I think some of this, the broader move is just to get some cost out and deal with some of the overbuilding they did. But yeah, as you say, I suspect that this particular very focused action has a lot to do with the union situation.
Let's talk about Walmart partnering with resale
We
platform.
never talk about Walmart. Let's get there.
Let's talk about them again. The important company doing interesting things. Let's talk about now this really interesting thing. They're partnering with resale platform Rebag. I've been reading in about how they're in the dupe thing where they've got a Birkin bag or a W bag or something like that. So they're doing interesting things with their merchandise.
Yeah, well, the dupe Birkin bag, it didn't take long, I think, for them to get a call from Hermes headquarters saying, we're going to sue your ass. But,
I don't care how big you are.
Apparently, that is no longer available. But what's interesting I think a few things that are interesting about this. So there are quite a lot of these resale platforms. We've had, for example, the CEO of Fashion File on. So there's quite a few of these that are in the resale business of handbags, jewelry, et cetera. Well, first of all, I think it's really smart for Rebag to have this kind of platform because just the exposure is tremendous for them. So I think it really has got to be, I don't know the terms of the deal, but just in terms of really elevating and growing their business, it's got to be tremendous.
We're talking about Rebag now, for example,
And for Walmart to appeal to make their marketplace in general more powerful, their marketplace, I was interested in this statistic. I knew it generally, but the specific story talked about how Walmart's overall marketplace offering the sales has grown over 30% for 5 consecutive quarters. So that's becoming a very important growth driver for them outside of kind of the traditional Walmart offering, both in store and online. But to appeal to higher end customers, to give Walmart a little bit more fashion credibility, this is a great branding thing for them, as well as whether, it drives any significant sales. But as people might know, this is really a way around the traditional luxury distribution strategy. These brands with new product would never sell to Walmart. They'll never sell to Amazon. They won't sell to Macy's, Kohl's, et cetera. They're really focusing on those specialty stores or online players like Net-a-Porter and My Teresa, as well as Neiman Marcus, Saks, et cetera. So these brands are very protective of it. But because this is resale, none of those factors are in play. So for a value retailer to offer this very elevated product is very unusual. So I think it's brilliant in a lot of respects. I don't think it'll be huge volume for them, but it's a really interesting way to attract some different customers and, like I say, kind of elevate their positioning. Now, I don't know if there are many other opportunities like that because the big opportunity is selling new product, and I don't see that kind of thing happening in my lifetime anyway.
Last story, and it's kind of a fun one, actually. Call Her Daddy founder, Alex Cooper, and folks listening may or may not be a listener to Call Her Daddy. What a phenomenon it is. They may remember she had Kamala Harris on as a guest, so that may kind of broke her open, so to speak, in a broader context. But she is launching a new beverage called Unwell, I think in partnership with Nestle at Target. So, I like this trend of podcasters launching beverages and products. Steve, what beverage or product should we launch together? What do you think?
Well, I don't know if you would want to sign up for this, but I kind of envision a line of products, if I can get the Celestial Seasonings people to partner with me. Instead of sleepy time, it could be like sarcasm time or cynicism time or schadenfreude time. I think that would really very in line with my brand.
Beyond brand. I think it would be
very,
on brand.
Very on brand. I don't know if that fits for Celestial Seasonings quite as much, but anyway, call me. We can talk.
All right. Call us if you're listening.
Now, how about you? You haven't offered up.
I was thinking
barbecue, probably, right?
Well, it would be probably connected to that, but I think I like the sarcastic seasonings is what I was thinking as part of
sarcastic. Nice dry rub for your
nice dry rub,
brisket.
Very dry, yeah, very dry. Anyway, something we can work on in our spare time. Now, just before we get to part 2 of your 2025 provocative predictions for retail's future, I did want to dedicate this episode to a good friend and partner. You know him as well, Kent Allen, who sadly passed away way too soon from cancer. So those of you who are listeners may know Kent, have seen him around. He was a great human being and taken from us way too early. So our thoughts go out to his family. All right, let's get to part 2 of your predictions. Next prediction, I was trying to eke out some kind of optimism out of you for the department stores.
I predict Steve will remain a cynical bastard for 2025ve.
Again, not a prediction.
That's your prediction.
Really. Not a prediction, really.
That's an observation.
Exactly. Number 7, department stores keep running to stand still.
Well, that actually may be a bit of an optimistic prediction, because I do think that despite, this is what I call the stall at the mall, because most of these guys, Macy's, Penny's, Dillard's, Neiman Marcus, Nordstrom, Belk, Saks, et cetera, plus, a lot of retailers in Canada and Europe, et cetera, are experiencing the same kind of thing, which is their business has been losing market share for many, many years. They're all closing stores, cutting costs, trying different things. I mean, just to give some numbers to it, for one of the worst players. Now, they're actually, as most people will know, largely off the mall, but still really a moderate department store, our friends at Kohl's. If you look at Kohl's sales compared to 2019, so the year before COVID, their sales, and they've actually opened some stores, are down by 17% in a 5-year time frame. Now, this is despite a really successful program of rolling out Sephora. And when we look at the numbers at Sephora's had positive comps, I think, pretty much through that whole period. And it's also a period where physical retail, as well as retail overall, is up a lot. So they have really lost a lot of share. But it's really the same story at most of these other players. So I talk about the curse of the timid transformation and leaders leap. And this, to me, is just a great example. And I think the problem, if for most of these guys, a little bit different depending upon who exactly we're talking about, whether it's in the U.S. or outside of the U.S., is really 90% business model and maybe 10% macro factors or execution. There are definitely opportunities to execute better at most of these retailers. It has not been helpful. The trading down phenomenon, that's definitely cost them some business. But it's really a broken business model that's very difficult to change, as we've seen by these efforts that aren't yielding much results. So I expect that overall, the comps are very likely to remain negative, which means they will continue to lose market share. I think we will see store closings accelerate, because that's kind of the easy thing to do that a lot of boards and investors demand. So yeah, I really don't see much of a change. If anything, it could get quite a lot worse. Now, my wild card here, my third wild card, is that Kohl's could become part of the new Catalyst brands that we talked about in the news segment. And I say that because there are a lot of similarities between Kohl's and Penny's in terms of their business model. But Kohl's, as I mentioned, and most people would know, is off the mall. Penny's is largely on the mall. So the ability to rationalize a lot of real estate, because they have very similar customers, could prove to be quite attractive. And what I assume is going to happen more aggressively at Penny's is some of the brands, the manufacturer brands like Nautica and so forth, that are part of this group will end up being part of the assortment at Penny's, but they also would be a good fit perhaps at Kohl's, which would give those brands hundreds, depending upon how many stores you keep, hundreds and hundreds of new points of distribution. So now I actually think this is a better prediction probably for next year, because there's a new CEO at Kohl's, and I doubt he's going to get there and then 3 months later say, hey, why don't we sell the company and fire myself? Yeah. So, but as well as just also, as we talked about, the new corporate structure at Catalyst Brands, that's going to take 6 to 12 months at least to really get together. Yeah. So I'm just putting that out there on the off chance that it starts to become a topic of the conversation by year end. I think there's a lot of merit to it, but yeah, it's probably another year or two before that would make a ton of sense.
For your next prediction, Target, you're talking about Target, has a special place in my heart. As you know, they had one of this fiasco that happened in Canada. But then as I got to know Target in the U.S., I was quite impressed. We've had some guests on from Target. Very fine organization that seemed to be doing all the right things. But somehow, last year, the wheels kind of came off. What do you think is going to happen in 25?
Well, long-term listeners may know that we talked about Target. Well, if you've really been along for the wild ride of the last 3 or 4 years, you know we said a lot of complimentary things about Target, largely around this hybrid distribution, using their stores as fulfillment centers. In fact, we had the woman that ran that area, who's now a different job, talk about it. And I think it was very impressive. And most analysts, myself included, credited that program for quite a bit of their success. But yeah, the wheels have come off, and I think 2 things are going on. One or maybe 3. One is the macro factors with Target having a bit more tilt towards discretionary and home products. That's not been their friend. So their merchandise mix is part of the reason why they've not performed well. The other reason is that just Amazon and Walmart and Costco are just executing so well, and Target's execution has been kind of hit or miss. But I also think that maybe we were faked out a little bit by kind of the COVID impact, because as more of an essential retailer and with consumers having a lot of extra spending power because they weren't going out and because of government stimulus, they may have just ridden that wave a little bit more. And I think while their supply chain technology sort of issues were helpful, they're very similar to what Walmart did. And now it's really about taking care of the customer. And I don't think they're executing the front of the house, the customer-facing stuff, or the regular kind of physical retail e-commerce stuff nearly as well. And I've noticed, it's a small sample, but I've talked to some other people about this, the housekeeping in their stores, the out of stocks, seem to be a real issue. And I've gone into some of their competing Walmart stores, and Walmart's execution is really good there. And so I feel like the format's a little bit tired and they're not executing that well. So I think that one outcome is Brian Cornell is out, or at least there's some wholesale leadership changes there. I got to think the board is losing patience unless they start to really turn that around the next quarter or two. I think it's been a while and some action needs to happen. I think they might.
There's been a lot of changes on that bench. If I think back to the last 18 months, there's a lot of names rolling through CMO positions. And as you said, technology positions and innovation positions. The one that hasn't moved is Cornell.
It's true. And some of them are people that have definitely left voluntarily, which makes me think they didn't like what they saw. But I don't have a full picture of that. So I also think we might see some store closings, even though Target has talked about open 100 or something stores over the next few years. I think, they've got to have some low productivity stores. And again, that's kind of like we talked about with the department stores. Often there's pressure to show action, and store closing makes it look like you're doing something, even though it might not really help you. So anyway, I do think we're going to see some pretty big changes at Target. My wild card number 4 prediction here is that Target actually gets taken private. Now, I will give credit to Scott Galloway for planting this idea in my head, not directly. He said it on his podcast. And I thought, that's actually really interesting, because it is another great brand, certainly. Got a lot going for it to work with. But some of the things they need to do are going to be expensive and take a lot of time. And that's generally not what the public markets like to see. So maybe somebody like a Sycamore or one of these other big private equity guys that could put a deal that together. And actually, if Brian Cornell thinks he's going to get forced out, this could be his Hail Mary move of getting him to stay in, where he doesn't, he would be dealing with a different group of directors, basically.
All right, let's move on to number 9. We were just talking about store closures for Target, and we've talked about that. What do you think is going to happen? Closures, openings? Is the retail apocalypse back on? Was it always the canard it was? Where did I see that in the headlines? I saw that in the headlines in CNN again. I think it was in the context of Party City or something like that.
Yeah, well, it's great. It's great clickbait. I mean, the retail apocalypse narrative was never true. It's not going to be true again. Physical retail is going to continue to grow. I'd be willing to predict that sales through physical stores will be up this year as they have been every year for, I think, 15 years since the financial crisis, I think, basically. So there's physical retail is clearly overall very strong, but there's a lot of retailers that continue to struggle. And generally speaking, because of the growth in digital, and because generally there have been a lot of concepts that were expanded without good underlying economics, we're going to see a lot of store openings or store closings, I should say. We even before a lot of times people think, like COVID caused all these store closings, and it definitely caused quite a few store closings. But store closings were actually increasing the couple of years before COVID, and that had a lot to do with just the weak business models being pressured by better business models, particularly Amazon and others. So I think we're in this dynamic again where the COVID bump that kind of raised the tide for a lot of retailers is now pretty much gone. To the extent I'm right about my first prediction, that's going to be a slow year. I do think we're going to see store closings exceed store openings this year. That was true last year, just slightly in the US, and I believe the UK as well. So it's just really a fundamental issue of lots of mediocre players who have a lot of capacity chasing too little demand, and this concept I've been talking about for a decade of death in the middle. So we're really seeing this in some of the closings that occurred towards the end of the year. We've really started to see this with drugstores. CVS and Walgreens are just, what is their exact value proposition that requires them to have so many stores? So it's kind of like what started to happen to department stores 10 years ago is happening in some other sectors. The other piece, it's not exactly around, dead on this store closing prediction, is I do think we're going to see reimagination of malls pick up steam. Now, some of that is going to be because it's long overdue, and some of the dynamics for some malls are so poor. But as more stores close, it gives more opportunities for these it's a problem in some sense because you have fewer people paying rent at these malls, but it does free you up to do some different things at some of these shopping centers. So this is already the reimagination, redevelopment, repurposing of malls is already increasing, but I think we're going to see it kind of go to the next level, particularly if I'm wrong and that interest rates do come down more than I'm expecting.
Quick commentary on the role of stores. As you know, I do a store tour in New York City, and one of the stores I took Canadian executives to was the new Aritzia flagship store in Soho, which is actually one of 3 big flagships that they opened up in the fall. 2 one on Fifth Avenue, one in Soho, and then one in Chicago. And I was reading the CEO was saying, this is our number one in America, our number one new customer acquisition tool. 40 to 45% of all new customers come in through those stores. So just to remind people of the multiple purposes and the role of stores. And then if anybody's in New York still listening to us, go to the Aritzia store and then go to the Arc'teryx store just up the road on the same, I call it Canada Row there now, in Soho, because they're both very interesting stores with a similar kind of acquisition model imagined behind it.
Can I just say 2 quick things about that? One is when I talk to reporters about when they want to go down kind of this retail apocalypse narrative, I say, okay, for every retailer you can name that closed a bunch of stores, I'm going to name a retailer that's opened a bunch of stores, and it's not hard to do, right? So that's a little bit of just the yin and yang of this, but also to your point about acquisition, every industry study I've seen over the last few years talks about that acquisition dynamic, and I can tell you I've worked with several clients where I've seen their data, and that is exactly their experience. I've really yet to hear a study or work with a retailer that hasn't seen the acquisition dynamics of stores be very positive, and when they open new stores, their online business goes up.
All right, let's move on to number 10. And if you're an astute listener, you've been following along this far, you'll know, well, we haven't talked about Amazon as much as I thought from a store perspective, because we were talking about their grocery store, which had a kind of a start-stop. But you've been thinking more deeply about what might happen to their grocery stores. Talk about it.
Well, this is both kind of a positive or negative sort of thing. I mean, I think Amazon obviously has been trying to figure out grocery for quite a long time. We can go back to when they bought Whole Foods in the first place, but This is really more about their Amazon branded, their Amazon Fresh store efforts, as well as just what they're trying to do online. And as you point out, it's been kind of fits and starts. They pulled back. They tried different things. Now they've got yet another concept, which I know you visited. I haven't visited yet. And I still fundamentally think that this year anyway, we will continue to see lots of experimentation and a handful of stores get opened, but not a commitment to a lot of scaling. And by that, I don't have a firm number in mind, but I think they're at like 60 or 70 locations right now, which is nothing in the scheme of things. They don't have a significant position in any city. So, Chicago, New York, or whatever, those are places where you need to have 40, 50, 60, 70 locations in the metro area. And they're like 5. So I don't, mainly not that I don't think the new iteration is better, because I don't know for sure, nor am I necessarily skeptical that they can continue to improve and they have the resources and the smarts to do it. I think the issue is I don't understand what the value proposition in white space is. For them to have a significant grocery business, they have to start to take a lot of share points away from the traditional players. And I'm not sure what problem they're solving. Now, the difference with Amazon is obviously they have a ton of scale. They have the ability to invest in this in ways that 99.9% of retailers can't. So they have a lot of infrastructure to leverage. And I think importantly, and often not talked about, is for them to continue to grow their retail media networks at these high rates and get that profitability, it's important to sell groceries because the CPG guys have the ad dollars. So I think they look at it in a way that's different than Trader Joe's looks at it. So that makes it hard to predict. But anyway, my prediction is that we won't see a lot of scaling this year because I think they will have a hard time getting the numbers to pencil out where they would make a big commitment. Now, wildcard number 5 prediction here is maybe they jumpstart this thing by making a grocery acquisition. I don't know if that would get past the Justice Department, any of the new players that would really make a difference.
Different day.
Well, yeah, right. Certainly the Biden administration, I think there's no chance if they didn't approve the Kroger-Albertson thing. I don't think they're going to approve Amazon buying Kroger or Albertson or any of the other big players. So I actually think from an acquisition standpoint, it's more likely that they might buy Wayfair or somebody like that.
Now, we were talking off mic. I'm a little more sanguine than you are. Now, I visited their store in Lodi, New Jersey. It's actually was on the will be on the tour, was on my retail tour because I wanted, there's none of them in Canada, right? So it's very interesting for Canadian retailers to go see them, which is part
once
of
Canada is part of the U.S., you won't be able to say that anymore. Have you heard the U.S. of A? the new name.
That's pretty funny, actually.
Yeah, I did not come up with that. But
I'm a little more sanguine because I was there and I started thinking of their execution on the Amazon Prime connection. And there's a significant number of products. Now, it's not unusual for any retailer to have a loyalty program, but their loyalty program is so massive, and I think they've so underperformed using it in many ways. When I think about Whole Foods or their physical attempts, and I thought they did a much better job at the grocery store that I saw. 40% discounts, special offers for Prime. So there's a reason to go there versus go to Kroger because so many Americans are members of Prime, right? I mean, there's more Americans that are member of Prime that I don't know what the number is, but it's massive. And then I get some value out of paying for Prime again. Anyway, so that's where I'm a little bit more optimistic. And I did think they've got it closer to right. To your point, they've kind of reached parity with other grocery stores in many ways. I mean, they're in stock. Great. Right. That's kind of just, table stakes. So that's where I get a little bit more optimistic is if they can kind of connect those dots better than they have for 20 years. It could be something, It doesn't take much to shift preference if you got enough stores. And that's the other part. Where do you get those stores? Where do you get that real estate? Do you start converting Whole Foods? Because there's retailers I know that are taking mid to higher end concepts and converting them down, to your point about where the market is, saying, listen, there's less people want to shop at Whole Foods. Maybe they want Amazon Fresh, and we'll use the same real estate. So,
I'm willing to believe they've improved it, and I'm willing to believe they have a bit of an edge, but I don't think that's enough to get, 20, 30 million people to shift to having Amazon Fresh be their favorite store. And that's kind of the scale at which I presumably want to get to, but we'll see.
All right, number 11. Let's make a deal. There's so much dealing going on. Whether taking private, going private, doing M&A work, bringing brands together. Do you think that's going to pick up in 2025?
I think it's going to pick up quite a lot. I think in two areas at least. One is the IPO market heating up. We really haven't seen much initial public offerings of retailers the last couple of years. Two that have been talked about a lot, Shein, which is still struggling to get that done. So I think it will probably happen, but it's been, we thought it might happen this year and it did, or last year, and it didn't. Viore, now they just raised a bunch of money, but lots of investors that have been in some of these private deals for a while want to try to cash out, and there might be a good opportunity to do that. Not just with Viore, but several other private brands. Catalyst brands, the thing we talked about with Pennies, probably too early, but I gotta think that Brookfield and Simon, who aren't generating much profitability from these ventures, might want to cash out. But again, that might be another year or so. But I think the other one is a lot of these disruptor brands, which have really built strong names and decent customer bases, but have a pretty weak operating model. So you can imagine a bigger player, maybe like a Samsonite or somebody buying Away, a bigger beauty conglomerate buying Glossier. Yep. Some of the we have footwear brands like Allbirds, clothing brands like Untuckit. These brands have made a mark and have decent revenues, but they're not exactly lighting it up. And I'm sure some of the investors that have been in some of these deals for 10 years plus wouldn't mind getting out. So I think the public markets will be, or just the capital markets will be much more favorable than they've been. Now there's still the rattling around of investors going after Macy's, going after Kohl's
regularly.
Some others
regularly. Taking a swing at them. I don't know.
Yeah, I think a lot of that is based upon how you think about the real estate, and as we've talked about, I don't get that so much. So I think there'll be a lot of discussion about it. I would be skeptical that the department stores are necessarily going to see these sort of deals because the underlying economic models or underlying economics are tough. And I think the real estate thing is a little bit more of a pipe dream than a big driver. But, if their prices get low enough, it can happen. And Macy's and Kohl's have really struggled. Their stock prices are down quite a lot from where they were.
To wrap it up, number 12, and this is something that we've been thinking, we've talked about it before. There's actually some new research out of a university in the U.S. that talks about a 6% decrease in consumption of food.
We're talking about retailers taking action to brace for what some folks have called the Ozempic recession. So the recession being, specific to certain categories where, and Ozempic, as people will probably know, is just one of the brands of the class of GLP-1 drugs. And not only have we seen incredible results specific to the original indications for these drugs, which is really around diabetes, but weight loss more broadly, but also things like cardiac health, depression. I mean, now maybe some eventual studies will start to show more risk factors, or maybe these results aren't as profound as some of these studies have shown, but there have been quite a lot of very well-regarded, well-researched longitudinal studies that have shown really dramatic results. So there's been a ton of growth already. Something like 1 in 8 Americans have already used a GLP-1 drug. Now, that doesn't mean they're staying on them, but overall, the business is growing quite a lot. I think we could see, or I expect we will see, a lot more acceleration, both as people just see the results from their friends and go like, oh, maybe I should give this a try, but more so from some of the newer drugs that are coming out that are either easier to use as injectables or in pill form, which would be, I think, pretty transformative for a bunch of reasons. The big issue really for adoption is the cost. A lot of folks can't get insurance coverage for it, so if they're paying out of pocket, it's very, very expensive. So we would need to see either more insurance coverage or these prices start to come down because of competition or just less expensive compounds to produce. So I'm not sure. It's a little bit hard to say whether we will see a big acceleration of consumer use this year. But I think because it will happen, whether it's 18 months from now, 36 months from now, retailers are going to be bracing for it. And what does that mean? It means new products. So if you're in the CPG business, you got to come up with new products, both because of what you said, which is the caloric drop is causing people to spend less money on certain kinds of food, some of which are high margin items, but they're also eating differently. So increased demand for protein, increased demand for fiber and certain macronutrient rich.
I hear lots about fruits and how do you make fruits crave? The industry has 50 years of science based on tobacco. When the tobacco guys bought all the food companies on craveability and that's I think they've got to go back to the drawing board. Now, a couple of quick comments.
Think about just in terms of substitution on that. Just one example. Think about because one of the things that these drugs do for most people is they increase the cravings for. I mean, even alcohol has been shown to be people just less interested in drinking alcohol, but more in particular, very sweet foods. So if you're in the business of selling premium ice cream at $7-8 a pint, and that drops a lot because people are now eating bananas and apples. Well, the profitability of a banana and apple is pretty different on a unit basis than selling Ben & Jerry's ice cream. But also, many of the companies that are in the the addictive food categories, they ain't in the healthy food categories to the same degree. So it could be quite disruptive to the core businesses of many of these big food conglomerates. So that's where I think, not only do they have to brace themselves for what could be a big drop in demand and profitability, but they're going to have to find a way, if they're going to stay relevant and profitable, to offset that. So that's product innovation, that's acquisitions, a whole bunch of stuff. The other thing I was just going to mention briefly, and then I'll let you make your point, is there's the kind of the flip side, which could be quite positive for the fashion and apparel businesses. If you lose 20, 30 pounds, you need new clothes. Yep. So when you're in the cycle of just maybe refreshing your wardrobe or something wears out, and then suddenly it's like, well, nothing I own actually looks good on me anymore. That could actually be an interesting dynamic for people in the apparel and fashion business.
Well, that's one of the points I was going to make is the downsizing of the overall category, so to speak, and then the new, if 1 in 8 of your consumers have a need for a dramatically different set in their closet. I mean, that's good. That's going to it also drives the kind of the used market. I mean, it's so many. Right. Yeah. Your mind starts to just turn in so many, like less fuel going in airplanes. So it's just crazy how you can spin out. I also think. It's really that right now you're in this point where there's this battle between states or insurance companies who are saying, like, I can't keep paying for these expensive drugs. But in the fullness of time, they're going to start seeing what they were paying out in terms of cancers and heart disease and all these other things go down. So in a perfect world, the math should work better. And then, so far the knock-on effects or the negative effects are well outstripped by the positive effects. So this is like, to me, Ozempic is like AI. Like you can't talk enough about it, and it's far-reaching, and it's in some ways you can't, in the hype cycle, I don't think it's hyped enough. That's your bold predictions, dozen bold predictions, and of course, long-time listeners or new listeners will know that we'll come back to these predictions at the end of 2025, and you'll get a grading for them. That's a great episode, by the way. And thanks again to everybody listening. Thanks for keeping us going through to season 10. It's exciting for us, and listeners keep growing. So thank you for that. So for now, let's leave it there. Thanks for tuning in. New episodes of season 10 of the award-winning Remarkable Retail podcast are released each and every Tuesday. Find us on Apple, Spotify, or wherever you enjoy your podcasts today. If you liked our episode, please take a moment to give us a 5-star rating on Apple Podcasts.
And I'm Steve Dennis, strategic advisor, keynote speaker, and best-selling author of 2 books, Leaders Leap, Transforming Your Company at the Speed of Disruption, and Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant and advisor, keynote speaker, and media entrepreneur. You can learn more about me on LinkedIn. Safe travels, everyone.